Hello, hi. We can start with our call. Then we'll start with our market outlook from Sanjay Doshi, sir. He's head of research and investment from Abacus Investment Manager, Abacus Mutual Fund. So, Sanjay, sir, you can start with a monthly market outlook, and then we'll take to our portfolio update with Hitesh Arora, sir.
Okay, thanks, Elish. I hope the screen is visible.
Yes, sir.
Hello. Yeah, okay. Okay, welcome everyone to this session on market outlook. This is Sanjay Doshi from Abacus Investment Managers or Abacus Mutual Fund. Before we start, kindly accept best wishes for the upcoming festival season from Abacus Mutual Fund. May this Diwali bring in health, wealth, and happiness to everyone. In today's webinar, we will try to cover the following aspects as will be visible on your screens. We will look at global key events which has panned down during the last month and some implications for global and Indian markets. We will look at domestic key events, particularly the MPC decision on rate, as well as monsoon season update and the festive season demand. We will try to highlight some of these aspects. We will look at capital flows into Indian markets and global markets and how these have played a role in market returns. So we'll look at the performance of various local and global indices, and we'll come to our view on market in terms of economic output, the growth, and the potential for market returns. So that's the broader agenda that we will try to cover today in the next probably 20 to 30 minutes. To start off on global macros and the key events. If we look at the data which is available on your screens, when we look at the manufacturing PMI data which has come out for China and Europe, they remain in below 50 numbers, which basically indicates contraction in manufacturing activity. So overall, we see Europe and China manufacturing levels have seen a contraction for the last month. And for US market in particular, some of the data points have shown a decent number of expansion for manufacturing as well as services. But there has been weakening of labor market as we see in terms of non-farm payroll, new additions of jobs and jobless claims. So there's a mixed signal across various geographies in terms of macro data. In this context, we saw a key event for global markets when we saw Fed cut rates in September for the first time in this calendar year. It was a 25 basis point cut, which was largely in line with market expectation. The key action done by FOMC was a more of a risk management approach where they have taken into account the weakening labor market and therefore cut interest rates. But at the same time, they remain concerned on inflation, which remains higher. The Fed also provides a dot plot, which gives you some indication of how rate cuts can be looked at in the near future. And that indicates around 50 basis point of further cut in 4Q of this calendar. However, the FOMC chair was very quick to highlight that all this is not a given. It will depend upon incoming data in terms of macro numbers for employment, for manufacturing and economic growth. They also highlighted that the tariffs which have been imposed have started to see some impact in terms of pushing up prices, but the overall impact is not yet fully into numbers. In fact, the recent announcement that we had over the weekend of significant higher tariffs being looked at for China can further make the job complicated for Fed. All these actions are critical to look out because these will have an impact on how we can assume growth for US economy, which is the largest economy, and the dollar index, and in a relative basis, how it will impact the trade activities and economic growth for other economies. Looking at tariffs and measures beyond tariffs, we have seen Indian certain exports being impacted by higher tariffs that these sectors have to face after US added another 25% penalty tariffs on India. So there are certain segments of market where export to US gets impacted. Two key announcements came out in the last month. One is with respect to Indian IT services as an opportunity, where H-1B visa application fees have been hiked very meaningfully from around less than $1,500 per application to more than $100,000. So this has been a very large increase for new H-1B applications. And there is also a change in the way these applications are processed, where earlier it was a lottery system, but now it will be favored more to higher salary applicants. In a way, US is focusing more on higher skill sets to enter into the economy and support. And in this manner, we can see the cost go up for Indian IT service providers, and there could be some impact on profitability. The other major announcement which had come out was on the pharma sector, where US had declared to announce around 100% tariffs on branded and patented imports into US. However, the decision has been put on hold for now. There was also further clarification that this 100% tariffs will not be applicable to countries where a bilateral trade agreement has already been signed, in which case a lower rate could be applicable. Further, there was an agreement with Pfizer, one of the largest drug providers, to whereby it would provide drugs to US market under the Medicaid program at most favored nation rates, which is at a much lower rate, and also provide on a direct to patient platform drugs at almost 40 to 80% discount. So in a way, we have seen pharma companies react to the threat of tariffs, and we have seen the decision to impose 100% tariffs on branded and patented drugs as on hold for now. If we look at the Indian healthcare and pharma companies, we don't see a real major impact from these announcements as of now, primarily because the generics and pharma intermediaries are currently exempted from tariffs. And as per media reports, it is unlikely that they will be brought under the regime of tariffs. Further, if we look at the announcement which have come in the last few days on the Biosecure Act, there could be an indirect benefit to CDMO and CRMO opportunities for Indian pharma companies, as these norms have been tightened for Chinese companies. So overall, from a tariff perspective, there will be certain sectors which is labor intensive, primarily which will see an impact of higher tariffs for the US exports. There will be IT services likely to see some cost pressures because of the hike in H-1B application visa fees, but pharma overall seems to have been exempted for now. If we look at how India is trying to take care in response to these higher tariffs, very clearly the government is focusing more on domestic consumption, domestic production, and ensuring that we open up markets for other exports. So we are looking at trade agreements with UK, with Europe, and obviously we are working on having the bilateral trade agreement with US. These negotiations will lower the impact of higher tariffs. At the same time, the government is looking at a proper package for affected sectors, which is mainly into the labor intensive sectors like textile and chemicals, which we are likely to see in the upcoming weeks if the tariff resolution doesn't take place. Overall, while the impact is not very large, but it would be important to see how these companies are able to adapt to these longer uncertainties, and if India could open up new markets for their exports. Moving forward to second area that we wanted to discuss today about Indian macros and events, where we will spend a little bit more time. To begin with, we saw the RBI hold rates in the beginning of the month, that is October, where the repo rate is kept unchanged at 5.5%. However, it is important to note that the commentary has been fairly dovish from the Reserve Bank. The inflation forecast has significantly revised downwards to 2.6%, which was as high as 3.7% at the end of June policy. So the FY26 inflation forecast by RBI is now down to 2.6%. And the GDP growth forecast for FY26 has been improved to 6.8% versus 6.5%, while in 1Q FY27, there is some negative impact of tariffs, which is where the GDP growth forecast has been revised down by 0.2%. Apart from the rates, the Reserve Bank have taken a series of steps to improve the banking system. To be very particular, around 22 new additional measures have been put in place. This is basically to improve the competitiveness of the banking sector, to ensure the flow of credit takes place in the desired manner, and to simplify foreign movements, foreign exchange trades. A key to highlight among them is first, banks are now allowed to finance acquisitions. The cap on individual company lending has been removed. The risk weights on NBFC loans to infra projects have been reduced, which will provide them with more funds to lend for infra projects. Lower weights have been put for certain segments, which will reduce the capital requirement, especially for MSME loans and residential real estate. And the regulatory restrictions on overlap in business between a bank and its other entities have been removed. So there are many steps which are taken apart from the rate decisions for ensuring a robust banking system and to ensure a transmission of rate cuts which have been happened. And the RBI has been very positive in its commentary. They've clearly highlighted with the kind of incoming data and the assumptions on future inflation, there is now further scope to look at supportive the economy in terms of further rate cuts. In a way, they indicated that government measures taken against trade barriers or higher tariffs are largely offsetting each other. But if this uncertainty continues for long and we see headwinds for growth, then RBI remains ready to step in and support growth. Coming to the next part on the domestic side, which we wanted to highlight is very good monsoon season. If we look at the overall monsoons till September end, we have seen 8% higher than normal monsoons this season. And the distribution is also fairly robust. So if you look at India's chart map in terms of rainfall distribution, there are only a few states in Northeast and East where there is a deficient rainfall, while the rest of India has seen either normal or minor excess in terms of rainfall activity. Also, the sowing area is higher by almost 1%, and reservoir levels are up to 90% of total capacity. This bodes very well for the future crops of Rabi also. Now, in our view, all this is fairly supportive for improved rural income and rural spending. At the same time, this will also be very supportive to control food inflation, which is a major part of CPI, which RBI keeps a tab on. And with food inflation likely to be under control, it further improves room for monetary action if required. So a very good monsoon and a potentially good harvest in current as well as Rabi season bodes very well for rural income and spending, and probably more action required from the MPC. Would like to spend a few minutes on the GST reforms and the benefits that we are likely to see. So September saw the implementation of the next set of major reforms by the central government on GST, where we have simplified the tax structure to only two slabs now, the 5% merit rate and a standard rate of 18%. And we have done away with two other slabs, which is 12% and 28. Uh, in terms of overall benefit, it probably translates to around 0.6% of GDP in terms of annual household savings, which the consumers can look to spend in terms of the extra income that they would have because of GST cuts. We believe this will have a positive impact on certain key segments like two-wheelers, entry-level cars, consumer durables, and to an extent on consumer staples and healthcare expenditure. And this is more like a Diwali gift to consumers from the government, and we are likely to see a very positive impact of these measures on spendings. Taking it further up, when we try to analyze the upcoming festive season, we are very enthused to see the great start to the festive season. Uh, Based upon the data that is available in terms of company releases and government data, the GST collections number declared in September, which is for August, is already up by 9%. This is quite comforting because there was an indication that there could be postponement of consumption ahead of the GST cuts. But this data basically highlights a growth even for the month of August. And in terms of the Navratra sales, the indication is very positive. India probably had the highest Navratri sales in a decade. where brands have announced around 25 to 100% growth across various categories. On the e-commerce side also, we have seen almost 30% growth in GMVs in the first week of the festive. In terms of retail registration of autos, it is up around 35% for the Navratra season across two-wheelers and cars, which is a very positive sign. And the bookings for the upcoming Diwali season also remains very strong. We have definitely seen the premiumization trend continue across durables, autos, and fashion, but more heartening is the revival in entry-level demand. This was a pain area for many segments of consumption. Some of the key companies which cater to the entry-level segment, they have indicated that this is probably the best Navratra season that they have seen in almost 3 decades. And based upon the bookings they have for Diwali, they are now planning for a growth in overall entry-level sales as compared to the previous peak seen in last 3 to 4 years back. So the earlier indications of festive demand is very robust, and we do expect the second part of the festive sales also to be equally strong. And going forward, we expect the monsoons being very stable and very good Kharif and Rabi crop to support rural income. And all the measures taken by the central bank and government in terms of boosting consumer income and ensuring there's enough liquidity and rate transmission will support consumption demand. In the next couple of years, we further see a support from the pay commission in terms of the hike that is being planned. Around 15% hike could be seen in salaries and pensions for central and state government employees. And these have a direct bearing on private final consumption, which we have seen in the previous pay commission hikes also. Overall, these extra income is likely to be spent in areas like autos, in travel, in education, health, and even affordable housing. So this support in terms of improving income and the hands of consumers is likely to be further taken a fillip with the pay commission hikes, and this will be a boost to consumption demand going forward. Lastly, on the domestic side, just to take a view on rupee as well as forex reserve, we have seen rupee depreciate by almost closer to 4% so far in this calendar year. However, the volatility is not as severe as some of the other emerging market currencies, which is a good sign. As far as the forex reserves are concerned, we are at almost all-time high of $700 billion, and this provides enough cushion to take care of any trade eventualities. So overall, on a macro level, India seems to be on a very strong footing. Coming to our next sections of flows and how these have impacted various markets and returns. If you look at the chart which is available on the screen, we'll see India having a lot of reds in terms of foreign outflows. In fact, this calendar year so far has been among the highest outflows that we have seen from foreign institutional investors. And the flows have actually gone into markets which seems to be relatively better priced in terms of valuations as well as an opportunity for growth and geopolitical sanity or less of tariff areas. So we have seen China, Korea, Taiwan, and similar markets receive more of inflows from foreign investors, while India definitely saw impact, obviously because of the slowdown that we had in the last year in terms of earnings growth, the valuations at which we were trading then, and now with geopolitical tensions and tariff issues, we have seen foreign investors cashing out of India as of now. If we put the same numbers in terms of FIIs and DII flows, as I highlighted, CY25 in the first 9 months, foreigners have withdrawn almost $17 billion worth of investment, which is as good as the highest annual outflow that we have seen by them in CY 2022. So, in a sense, foreigners have withdrawn a large amount of liquidity or investment from India, while the domestic flows continue to remain very strong. If you look at mutual fund flows, even in the last month of data that we have seen, the SIP inflows have reached a record high of almost 29,000 crores. So in a way, the domestic flows are counterbalancing the FII's outflow. As I mentioned earlier, we see a direct correlation between the availability of opportunity to grow and the way the markets are priced and the foreign inflows. So putting all this into context, we see a good probability that foreign outflows will stop, and as we see growth picking up, and if we see a resolution to tariffs in terms of trade agreement with US, I think these foreign outflows can reverse, which will be a very positive outlook for Indian markets overall. So far, what we discussed, to put that into context of market numbers, if you look at the last 1 month and even last 1 year, Indian markets have felt relatively subdued as compared to other markets like Korea, Taiwan, China. And this primarily, as I've highlighted, is a reflection of slower earnings growth for Indian companies and the valuation that we were trading with, along with the geopolitical tensions that we had and the tariff issues that particularly haunt in terms of certain market segments for India. Uh, so that's the basic summary on terms of market returns, and we expect this trend to reverse. If you look at from a little bit longer term perspective, Indian markets have done commendable well in terms of providing return to investors, which is in line with the earnings growth. To broadly summarize on the macro front, our economic growth remains fairly strong. 1Q GDP has come out around 7.8%, which was higher than most expectations. The inflation remains fairly under control, with CPI is around 2%. Our GST collections, which is an reflection of economic activity, remains strong and has shown decent growth on a YOY basis. Uh, our repo rate cut, there seems to be further room as indicated by the central bank if need be. And importantly, on a global level also, if you look at Brent crude, which has a very big bearing on Indian economy, it's been on a downward trend and has been very benign. Currently, the Brent prices have fallen below the current numbers of 68 as seen on the screen. And this bodes well for Indian economy from a medium-term perspective also. In terms of where we stand in terms of valuation, we are now closer to long-term averages for around 18 times 1 year forward on Nifty, while our Nifty ROEs remain strong at around 15%. Uh, Putting this in context of an expected revival in growth in second half and in next fiscal, I think our markets provide scope for significant upward movement linked to growth. If we try to take it up on a sectoral basis, it will be clearly visible that auto in particular has seen an improvement in terms of performance and now trades above long-term averages. This is a clear reflection of improvement in demand, which is visible in the festive season and the various measures taken by government to improve income in the hands of people. And there's a clear reflection of auto demand revival. Similarly, we see pharma and cap goods remaining above averages, driven again by the earnings growth potential. IT in particular has seen a dip below its historical averages. And this is again a clear reflection of headwinds for the space in terms of growth, in terms of technological changes, and now the H1B higher cost. So sectorally, again, what is prime to look out is how earnings growth are visible for each of these spaces, and accordingly, and the longevity of that, which has a bearing on the valuation that these sectors trade at. Just to summarize it in form of a table, the last month in particular saw impact of negative returns for IT and healthcare or pharma, again driven by global news. While domestic side, we saw revival in autos and financials, and that is where the returns were seen in terms of sectoral exposure. Lastly, before we try to conclude our entire discussion, just to highlight at a Nifty level, our revenue and PAT growth for the last few quarters has been fairly subdued. 1Q FY26 revenue growth came in at 6%, which was largely in line with most expectation on street, while the PAT growth was much better at 8%. Again, not good from a historical standard, but if you see at the last 3 to 4 quarters, there has been some revival in PAT growth. Uh, 2Q again may be a similar on lines, primarily because of postponement of demand ahead of the GST cut and some impact on export-oriented sectors. However, the second half is likely to be much robust, and that will be visible in the earnings growth for the second half for the current fiscal. Finally, trying to summarize everything and looking at some of the concerns that investors would have on their mind. Very clearly, last 12 to 15 months have been a challenge in terms of making returns in Indian markets. And that is primarily driven by the slowdown in earnings growth that we saw. This was because of the extended monsoons of last year having an impact on rural income. This was because of the elections, which led to postponement of certain government capex and overall uncertainty because of geopolitical and tariff issues. Uh, Taking the actions that the government have done over the last couple of quarters in particular, in terms of reducing tax rate and improving the income in the hand of consumers, the GST rationalization will definitely be positive for higher spending. Similarly, RBI has been very proactive by improving the liquidity in the market. From deficit, we have gone to surplus. At the same time, they have ensured that rate cuts are finally transmitted and reach the end consumers, and they remain further prompt to act as required. In addition to that, we have very good monsoons, and this will be very positive for rural spending and incomes. And we have already seen a good response in early part of the festive, and the reflection is that even at the entry level, demand has started to revive. All these bodes well from a near-term outlook. And from a medium to long-term basis, clearly India's demographics is an advantage. We should be looking at an improvement in manufacturing opportunities in India as global supply chains realign, and this will support growth from the medium to long term. As I mentioned earlier, 2Q FY26 may again be little subdued on revenue and PAT growth, given there was been postponement of consumption due to GST reduction rates coming into effect and certain uh, export-oriented sectors are being impacted. Further, financials can also see pressure in the near term as liabilities get repriced at a later stage as against your assets. And this is probably going to reverse very quickly in the second half, which will be reflected in terms of double-digit growth for companies in the terms of profits. And with valuations at around long-term averages, we see markets to deliver again in line with earnings growth. Key risk which we would still like to highlight, which one needs to be wary of. Very clearly, geopolitical news flows continues to be very volatile. In fact, on Friday itself, we had another news flow about very large tariffs likely to be imposed on China. These kind of news flows have impact on the markets in terms of the adding to uncertainty as well as the ability to look at growth. Second, we would like to highlight the sustenance of revival in consumption that we have seen as of now. It is very important to keep a close eye about these trends in the second half. And largely, any global major economic shock can have an impact on emerging market flows, which again could be a reason for markets to be subdued. So I think I'll stop here. And just to summarize again, we remain hopeful of recovery in demand as seen by the early festive sales. And we see enough action being taken by government on the macro front in terms of improving the income level for the people, as well as the Reserve Bank of India acting in time to ensure the rate cuts and liquidity is supportive of growth. In terms of overseas market flows also, given how we are well placed in terms of recovery on growth, as well as the large outflows we have already seen, this trend could reverse if we are able to have a logical conclusion to the tariffs issues. And in all of this will be supportive of returns from market going forward. Thank you. Back to you, Sailesh.
Thank you, Sanjay. Thank you. So the next we can thank you for that. Hitesh sir, you can share your presentation, and Hitesh sir, you can give a brief about Abacus Asset Managers, the PMSAF, a brief about the philosophy and thought process behind selecting stocks, and a few on the portfolio update. Yeah.
Is my screen visible?
Yeah.
Yeah. Okay. Thank you. Thanks, Charlie. Good evening, everybody. We'll start with the portfolio update, our investment thought process, and then all the offerings on the PMS. What does the portfolio comprise of, valuations, etc. So just to some of these things we've discussed, but I think it's important to emphasize how we look at investments, how we look at bottom up ideas. So we are very bottom up investors in that sense. We have a very we look at fundamentally underpriced stocks, where we think we are buying cheaper than their intrinsic valuations. We believe in generating alpha over a period of time, and we look at business models that are scalable over a period of time. So what essentially we are looking at, it's a mid cap company can become the next large cap, or a small cap company become the next mid cap over our holding period. As I said, we are very bottom up driven investors. We look at we let the numbers speak for itself rather than presentations. So, I think that is very important for us. Numbers are very important for us. The other bit is we've got a very strong team of analysts, and we do very bottom up research. We visit factory floors, meet company managements. Just last week, Sanjay and myself, and a colleague of ours, were on the ground meeting managements. So one or the other of us are generally traveling and meeting managements. We are happy to be contrarian in the sense we open to look at companies across sectors, across market caps, across cycles, and we don't chase momentum. So we'll do our own bottom up research. We're not looking at necessarily what others are buying in their portfolios. We What works best for us is our independent thought process, and that's held well for us. The other bit important is we are patient investors, so we are buy and hold investors. We hold stocks for a longer period of time. And what does that mean? We hold stocks for say generally 3 to 5 years of time. And I'll explain that over the next couple of minutes how that helps us. So there's something very unique to us. Just to delve a little more into our investment style and how it is governed by. It's governed by something that we call is the MEETS framework. What we look at is the quality of the management. Ultimately, it's the quality of the management, is the people that are running it. And what has been their track record in the past, how they've treated minority investors, if they've made errors in decisions making, whether it's been business errors or worse, or they could be avoidable mishaps. So that gives a very good reflection of the quality of the management. And what is the ROEs that they've generated. So the management track record is very important for us. What is the other bit is what is the quality of the earnings that are generated? Is it something that's driven by, say, one-off factors, for example, reduction in raw material cost, inventory cost benefit, etc., or is it something more structural in nature? As I said, can earnings over the next 4 years, double, or hence the valuations can more than become 1/4 of what they are, or sorry, half of what they are. So this is something essentially look at. Is the addressable market in that sense much bigger? The other bit is events or trends. So a simple example would be, are there any disruptive trends there that can impact our holdings? Is there something very simple would be if you look at ICE engines versus electric vehicles. So electric vehicles in that sense are very disruptive for the whole ICE engine ecosystem. So those are some of the thoughts that come in mind when we thoughts that we evaluate when we look at events when we look at stock market investing opportunities. The other bit is timing, and this is very important. A good company is not necessarily a good investment. And what do we mean by that? So I'll just elaborate by an example. If you look at Unilever, Unilever is an excellent company and it's an excellent brand. It's products that we use on a very day-to-day basis. So all of us are aware of the company, but it's an excellent company, but it trades extremely expensive. But whereas earnings probably grow in high single digits for the company. So for us, in that context, does it make does it make sense for us to buy this company and hold it over a period of time where earnings are probably compounding over high single digits, but multiples are, where they are. So this is one. The other example is if you look at a company like Bharti Airtel, this was a company that was, if you look at just a few years back, there was the competitive capex intensity was high, competitive intensity was high. There were a lot of regulatory issues, AGR issues, etc. But over a period of time, what has happened is the capex intensity has reduced, competitive intensity has reduced as one of the players has become weaker. And you've got much more regulatory clarity. And the companies have been able to take price hikes on a regular basis, which has significantly improved profitability. And since then, the stock has done exceedingly well. So if we were a participant when there was more clarity, you were as an investor, you were better off. So where we are investing in the journey of the life of the stock, I think that's very important. The other bit is structural. So structural, as we said, what is the TAM that the market, the company is addressing for it? For example, for this mid cap company that we are looking at, is the TAM big enough for it to become, as I said, the next large cap? And similarly for a small cap company over our horizon or holding period of say 3 to 5 years, can it become the next next mid cap? The other bit we do is, and what we look at is things that we avoid and things that are very important from a risk management perspective, because managing risk ultimately is extremely important from a investment point of view. So some of the things that we look at is one is called company risk. So extremely important risk, but how do we mitigate it? Mitigate is know your investment in and out from a fundamental standpoint. Know your company as well as you can do it. So there's no substitute for that. So focus on balance sheet, focus on numbers, focus on profitability on a very, very extremely bottom-up basis. So that's the best way to mitigate company risk, is knowing as much as you can about the company that you are investing in. The other bit is valuation. So there is no right or wrong valuation number, but yeah, we are wary of overpaying. So you maintain strict discipline there. The other bit is market risk. So one thing is you can't forecast on the direction of the markets over our holding period, but what we best way to handle market risk is one by being patient. The other bit is being a little more cognizant of the underlying market risk factors that may impact the prices. So if something that was very a company that we are investing is very susceptible to commodity prices, it would be good to know what is the underlying market environment there, what is the demand outlook, supply outlook over there. So to that extent, your cost or profitability could be impacted. The other bit is liquidity risk. So liquidity risk is in mid and small cap investing. Generally, liquidity is a near-term risk. But our portfolios are designed to take care in the sense that our holding periods are 3 to 5 years. Over this holding period, as I said, we are looking for profits to significantly improve. So not only our profits to improve, but also you would expect as the profits continue to grow consistently, the earnings multiple will also expand. So you will gain both out of the market cap will gain both out of the profitability as well as the earnings multiple expanding. So the market cap should significantly expand. So that in that sense should take care of the liquidity risk. And the last bit is the concentration risk. How do we try to take care of it? We, as you know, we have diversified portfolios. Our single stock limits are 10% of the portfolio market value. We also have a limit on the sectoral exposure, so that's normally around 30% of the portfolio market values. And single positions are also lower in weight. We've got around 30-40 names in the portfolio. In that sense, we're also from a single position perspective, we are fairly diversified. So yeah, what we don't do, I think that's very important. We don't chase momentum. We would let fundamentals drive our investment decisions rather than what the price movements are. So that's I think extremely important to us. We not momentum based investors. We'll do our own homework where we find comfort with the earnings, where we find comfort with the valuation multiples. Those are the names we would be looking to invest and not chase returns on a momentum basis. The other is we don't churn unnecessary. So no trading. We hold it for a longer period of time, as I said. So the benefit of that is over the holding period, not only over our holding period of say 3-5 years, not only our earnings compounding, but as I said, if our entry level multiples are cheaper, and as these earnings compound, you will also get your earnings multiple expand. So you've got a dual benefit of earnings compounding as well as multiples expanding. So hence it's prudent not to churn unnecessarily. The other is, as I said, we don't copy and mimic. We're not influenced by herd mentality. All our investments have to be worked out internally. The other bit is leverage. So credit risk, leverage is something we don't like until there's compelling reasons for that, because it's simple. It limits management's ability to take tough decisions, and market environments are volatile as they are. You could be just stuck on the wrong side. So it's better to avoid companies that have high leverage. The other bit is what about exit? How do you exit, or when do you exit? So while we don't churn unnecessarily, but there is also some things where we are very careful about exiting. So if the fundamentals are not panning out as expected due to whatever reason, say sector deterioration, company specific issues, or governance issues that we found out, we would exit the positions. Or we think if we are, everybody makes mistakes. If our thesis is not panning out wrong, we are happy to accept it and exit the positions. Or we find the other bit is, if we find a better opportunity, ultimately it's a more optimal usage of our time and money, then we'll exit and enter into another name. And the second last bit is if the position becomes insignificant, so it doesn't add to the overall returns, and we'll exit it. So this is some bit on the exit discipline. So yeah, these are something that we have. So we've got why us? What is our advantage? We've got a strong track record. We've been delivering across market cycles. So whether it was pre-COVID, post-COVID, and currently as well. So those are the things that I think in that sense we worked, and they continue to work for us. So hopefully it is in the numbers that tell for us. In the interest of time, let me just move to our to the product bit. So we've got 3 offerings, as a lot of you may be aware of. So the first one is the Abacus All Cap approach, the PMS offering. So this one is largely, I'll just move to the next slide first before going to the next one. So this is largely a large and the larger mid cap offering. So across large and mid, we've got around 70% of the portfolio, followed by mid caps at around 24. So that is the offering there. These are the numbers. These are the top holdings that we have in the all cap approach. we like banks, lending institutions, banks, NBFCs, so youths and capital good companies. So you would see the portfolio preferences there as well. So, banks are around 19% of the portfolio, NBFCs around 10, and industrials is around 13%. So these form sort of bulk of our portfolio. These are the names, and which is also reflected in some of the names of holdings. I'll just give you a quick 10 seconds to review the portfolio names and the sector classifications as on September month end. Yeah. So as I said, this is essentially portfolio comprises of large caps and larger mid caps. The other bit, and yeah, this is the sort of the portfolio performance as on September month end. These are the portfolio valuations that we have. So we are looking at ultimately for any portfolio, its earnings growth is a strong component of it, because earnings growth ideally should reflect in stock price growth. So we're looking at portfolio earnings of around 17% for FY26. That's the estimated earnings, and for FY27 we're looking at around 23%, and ROEs in the range of 14 to 15%. The other bit is we don't like leverage, as we said, so that should hopefully be reflected in our portfolio's composition. So leverage is around 0.4 to 0.3 over the next 2 years. So yeah, that's on the all cap side. The other is the emerging opportunities portfolio. So we're looking at strong earnings growth, over 15% earnings growth. At entry level, the price multiple should be less than 15p and greater than 15% ROEs. So at least if two of these three criteria for each name that we're looking at should be met, irrespective of whether which strategy it is, whether it's the all cap or the emerging opportunity. The fundamental research process, the investment process, the thought process remains the same. We adhere to that bottom up basis and adhere to our MEETS framework. By sort of design, this is a portfolio that is more a mid cap and a small cap portfolio. So as per the current composition, around 87% of the portfolio is invested in mid and small cap names, and about 8% is in large cap. So bulk of the portfolio, closer to 90%, is in mid and small cap names. And this is the portfolio returns since inception as on September month end. And these are as I said, we like banks and NBFCs and industrials. So which should be reflected in the portfolio composition as well, as the case is here. And then the bit on the earnings growth, as I said, so we're looking at stronger earnings growth of around 18% and 24% for FY26 and 27 respectively. Leverage significantly lower levered portfolio, actually virtually nothing ex financials. From a valuation standpoint, again, the portfolio is much cheaper than the underlying indices. So and strong ROEs are around 14 to 16%. On an expected base, that's the expectation for FY26 and FY27. The third bit is the diversified alpha approach. So it's slightly unique approach. So I'll just take a minute to go through what the underlying approach here is. So here we try to build a portfolio of mid, small, and large and micro cap exposure. We try to control volatility through large cap and larger mid caps. but we also at the same time focus on alpha creation to to small and micro cap names. So while we get liquidity from larger cap names and larger mid cap names, we try to generate alpha from mid and small cap names. And what is the weightage of the stocks across market cap is 40, 30, 20, 10 for large, mid, small, and micro cap names. So this is a 40 stock portfolio with 10 stocks in large cap, 30 in mid cap, 20 in small cap, and 10 in micro cap, with weight of 4%, 3%, and 2%, and 1% each for each large cap name, mid cap name, small cap name, and micro cap name. So that is broadly the portfolio construct. These are the top 10 holdings that we look at currently. So this is in the table on the right, shows the top 10 holdings of the portfolio. And as we said, we like banks, NBFCs, industrials. So again, that is reflected in some of the portfolio composition of our, of our portfolio companies. So as I said, the portfolio company is broadly in line with what I just discussed. So it changes with over a period of time, as which stocks sort of do better or which market cap is doing better, etc. But roughly, this is the sort of the earnings of the portfolio and performance of the portfolio since inception. So this is a relatively recent introduction. So the inception date for this is mid-Jan 2024. But yeah, irrespective, that's the performance since inception. These are the portfolio valuations. And so essentially, we are looking at strong earnings growth of 13% and 21% for FY26 and 27. We are, from a leverage standpoint, again, the portfolio does is quite well. So, leverage is quite low here. ROEs are strong at 14 and 16%. And as I said, the PAT growth continues to be strong from a valuation standpoint. Also, we are relatively comfortable compared to the underlying index. Yeah. So, and that's that's our team profile. So pretty much. So I'll take a pause here in the interest of time, and if there are I think questions, we can take those.
Yes, sir. Thank you, sir. Hitesh sir, for the strategy updates, and thank you, Sanjay sir, for the market outlook. So let's start with the Q&A. To all the participants, just a part of our best practice policy. Let's avoid any questions related to the stocks. However, anything related to the strategy updates or market outlook, we will definitely look into it. So, sir, Sanjay sir, the first question is, considering the current tariff situations and the war, what are your views? Can we expect any global slowdown or any market crash? If yes, then how it will affect the Indian market?
No, so thanks for the question. As far as the geopolitical uncertainty is concerned and tariff issues are concerned, I think markets have overall taken it very well. The geopolitical issues in terms of wars have been ongoing in some geographies for more than 3 years now. They have an impact on supply chain. They have an impact on how one will be able to manage your profitability or your end markets. But I don't think they are leading to any kind of collapse in global markets. Uh, as far as tariffs are again concerned, while there has been a lot of noise around tariffs and how each sector on each country can be impacted by it, but there are a lot of efforts being made on negotiating deals with US, and we have seen many countries successfully do it. There are many spaces where there have been temporary pauses. So this is again a medium to negotiate and bring somebody on the table. And at the same time, it provides you an opportunity to put in place a longer term framework to support your end markets. So again, I don't think these will lead to collapse in markets. If you are asking me to predict how the collapse comes in, it is a very difficult thing. And normally black swan events are not easy to predict. So we should avoid trying to spend more time on that. Structurally, you would be better off looking at long-term growth and the opportunity which market provides. To your simple question, I don't think any of these will lead to collapse. Obviously, we'll have to take it on a case by case basis for each country and each sector.
Okay. The next question is your views on the Q2 earnings update.
Yeah. So as far as the current quarter estimates are concerned, what we have seen is these are likely to be largely in line with what we saw in 1Q of FY26, which is roughly around 6 to 8 or 9% growth in revenue and PAT. These are again broker estimates or sell side estimate that we have seen. The beginning has started in terms of IT earnings, which is again a little bit muted, and this was precisely what was estimated by a few results that have come out. As I mentioned, that on domestic consumption side also, there has been some postponement as GST rate cuts and the festive demand. The full impact will be seen in 3Q numbers and going forward. Similarly, the benefits of better income in the hands of consumers, the RBI action on rate cuts, as well as the monsoon support in terms of agricultural income and spending will be visible in second half. So we do expect second half to be much better in terms of growth, and the current quarter will be largely in line with what we have seen in the first quarter. Hitesh, if you have any particular comments, please do add.
No, yeah, I think as you also already alluded, the festive season has been strong. So in that sense, we should see for a lot of the consumer companies, we should see strong growth. But in terms of the inflection point, I think Q3 is the inflection point for looking at significant earnings growth from here on.
Okay. So the next question is with regards to the trade wars between US and China. Can India get any advantages here?
Okay, I will first share a few thoughts over here. Um, as far as trade wars are concerned, I don't think relative basis there will be any large gains on a sustainable basis because every country will look to negotiate individually. It is very difficult to go as a bloc, and the power remains at a major economies in terms of end markets. What is happening apart from this trade wars is there is a definite need to relook at supply chains across the world. And we have seen that even before the trade wars, when we looked at all the geopolitical tensions and the kind of dependencies that major economies have on China, they were already looking at an alternatives for various subsegments of their markets, whether it's be pharmaceutical or telecom or engineering goods. So every market is going to get an opportunity. At the low end, even countries which are more labor dependent can have their own say. So I think supply chain realignment provides you a larger opportunity. On a relative basis, as of now, India doesn't seem to have been gaining a lot in terms of trade wars, though the initial reaction during the tariffs was that we may probably close a deal very soon, but that has been delayed to an extent. So I don't think it's going to be a everlasting impact, but realignments of supply chain will provide much bigger opportunity. Along with that, the government focus on supporting economies in terms of reducing import dependency will be very good for long-term outlook. Hitesh, you can add your thoughts, please.
So I think you've summarized well. I think on the supply chain bit is the important bit.
Okay. The next question is on the luxurious metals, exotic metals, that is gold and silver. Your views on gold and silver, and if you're planning or wish to add this in our strategy.
Hitesh, I will request you to take it.
No, this is outside. We don't invest in precious metals as such. So we don't do that. But where we invest is in companies which are, say, into base metals or precious metal mining or converting in the process. So from there could be a beneficiary. So we have some exposures there indirectly at least where it can benefit from the price increase of the likes of some of the metals that you're talking about. But direct exposure to these commodities, that's outside the purview of our investment philosophy. But as I said, there are metal companies which have a indirect exposure to some of these commodities that you mentioned, where we continue to hold and benefit.
Okay. Sir, Hitesh sir, this is for you. This question is for you. Can you provide a brief summary on the upcoming strategy for the PMS approaches, all three PMS approaches?
Sorry,
A
can
kind
you
of
repeat
strategy update. A kind of strategy update. What can we expect in future for all our three PMSs?
See, ultimately, it's a lot of it is broadly the answer is the same for all the three PMS strategies, because our underlying research process is the same for whether it is all cap emerging or diversified alpha. We are a bottom up fund house, so we continue to endeavor to provide returns that are better than the markets. Last few months, returns have been a bit lackluster on account of various reasons that we can discuss. But our medium to long term endeavor is to do significantly better than the market, and we continue to look for investment ideas with that perspective in mind.
The next question is portfolios are skewed to BFSI and industrials. Any potential risk you can foresee to this? Also, what is your view on consumer, especially in the discretionary space, and how does that reflect in the portfolio?
Yeah. So I think because of this whole, our portfolios are skewed towards financials, and that's correct. We found more comfort there from a valuation standpoint. Balance sheets are cleaner. Credit growth, given all the benefits that we've talked about, whether it's the GST rate cuts, infrastructure spending, and the sort of the banking sector reforms that RBI has talked about, banks should be a beneficiary of that, and we are at sort of I think the rate cut cycle is from the RBI is behind us. So we should also see the net interest margins of the companies of these banks normalizing. So in that sense, I think lending institutions are well placed. We also hold exposures in non-lending institutions, which also get sort of clubbed over here in the banking and the NBFCs position. So again, we see secular growth there, strong growth over there. So that bit is there. And also because of this whole discretionary spending, whether it is autos and premiumization or buying of two-wheelers or vehicles, by some way, whether it is personal credit offtake or whether it is corporate credit offtake, because when a company, when there is strong demand, companies go and invest in capacity expansion, and capacity expansion, some of it is from their own pocket, some they'll take it from the borrow from the bank, and then they rely on auto ancillary companies for supplying them the products. Again, this auto ancillary company will invest some of it from their own pocket, some they'll go to the bank. So you should see an uptick in the cycle. So hence, that's the thesis for holding lending institutions in the portfolio. The other bit is on premiumization. Yes, we like premium consumption. I think we have some names in the portfolio, though in hindsight we would have liked to add more. But obviously, there are always concerns around what are the valuations and multiples that we get. But that is a space that we like, and that is we hold some names, and we continue to evaluate more names in this sort of in this space. And yeah, so different ways we are playing this theme, and we continue to evaluate more names in the theme.
Okay. What are the worst and best performing sectors for the quarter?
Sorry, what are the?
What are the best and worst performing sectors for the quarter?
I think that is something we, if you're actually talking about Q2, we will get to see post the results. I think it's a little early to call that.
Okay,
Or
sir.
if you're talking about sectoral returns, that is a slide we had already shared. If you're talking about sectoral returns, that is a slide we'd already shared during the presentation. But if you're looking at sectoral performance in terms of the results, if you mean that, I think we'll wait for the results to come.
Okay, so I think we have covered major questions. We have answered all the major questions. And sir, any Sanjay sir and Hitesh sir, any concluding remarks from your side for this call?
Yeah, I mean, just to re-emphasize that second half will be very important to look for in terms of the domestic demand and earnings growth that we expect to see a recovery. Flows again could be turning positive from overseas investors, and that will be a reflection of growth and the negotiations on trade side because that uncertainty can be cleared. And just to conclude from my side, again, best wishes to all for the upcoming festive season. That's it.
Yeah, I think from my side, I think we're looking at an earnings inflection in this quarter, and we continue to evaluate names with full rigor to optimize returns for our clients across who invested across strategies. Yeah, that's the continuous endeavor, and happy Diwali to all investors who are on the call.
Yes. Thank you all for your participation. We look forward for the next month's event. Thank you.
Thanks.
Thank you, everyone.
All investments are subject to market risks. Please read all scheme-related documents carefully before investing. Performance and references to returns are indicative and does not guarantee any returns. Investor discretion is advised. This video is neither a general offer nor solicitation to avail the service of investment from the CB registered intermediary under the services offered by Abacus, nor is it an offer to sell or a generally solicit an offer to become an investor in the services offered by the Abacus. The delivery of this video at any time does not imply that information herein is correct as of any time subsequent to its date. The contents of this video are provisional and may be subject to change.